Good afternoon. This is Tom Alexander. It is Saturday, April 20th. It is about 11:15 a.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekend update that I do every weekend. If you're new to the channel, thank you for being here. Please subscribe. Please like. Please make comments. All of these things help with this YouTube algorithm. I'm trying to build my channel. Hope you find value in this. You can always shoot me an email at tom@alexandertrading.com. I send out free stuff during the week. Again, it's free, but you have to register. If you are not on my list and you want to be on the list, send me an email, tom@alexandertrading.com, and I'll put you on the list. Okay, we have a lot to talk about. We are in the first correction that we have seen since last October's lows. And if you go on social media, Twitter, Facebook, any of these places, or even watch CNBC. It's sort of amazing to me that there is so much consternation over basically in the S&P where it's a 5% pullback. The others have pulled back to varying degrees. The Russell is actually down almost 9%, but the Russell is its own animal, as we all know. But the SPX, the NDX, the Dow, and the New York Composite, which I'm going to talk about a little bit in just a minute, I'll show you some charts, are all well within minor corrections so far. And this is typical for a bull trend. Several weeks ago, I was talking about how unusual it was to have such an incredibly ramping market off of lows in an election year with nothing more than a 2%. We didn't even have a 2% from close to close decline in the SPX, and how rare that was. And I outlined going back in time, going back to, I think, 1980 election years, and showing that that had never occurred before. Well, here we are. So we're getting a little bit of turbulence. That's expected. I think there could be signs that we're near a short-term bottom. Let's take a look at some charts. Okay, I'm going to start with the SPX. So the SPX is off not quite 6% from print high, all-time high, to Friday's print low. Now, there is, for those of you that may be new to this channel and new to my work, may not be aware, I use only auction market data to help me identify quote unquote support resistance. There's really no such thing as support or resistance. There are inflection points that are created by the activity between buyers and sellers, and that's what I use to determine where support could be or resistance could be. But those areas are also always not only quote unquote support or resistance, they're also inflection points. You can get acceleration below support or acceleration above resistance. So that's a very important distinction, and it's a trader's distinction. Okay, so Friday, what was particularly significant to me about the SPX is we closed this giant gap that was formed on the 22nd. And then, of course, we traded lower. We had the overnight news of the little disagreement in the Middle East escalating. And notably, one notable thing about Friday was that none of the indices, even the NDX, even though it traded very, very deeply, none of them took out their Globex lows. So that's something I did notice that I think is notable. Now, if you look in this chart here, there's really nothing from an auction market perspective below Friday's low. And that's because this structure off of, beginning very early in January, so extremely vertical. There's not a lot of horizontal volume here. There's not a lot of double or triple lows. We're just sort of hanging in the middle of nowhere, okay, in terms of just pure price structure and price level. Okay, let's go to, let's take a look at the NDX. And the NDX is off almost 8%. A significant amount of that was due to Friday's decline. The next level below this level in the NDX is around 16,825, 16,745. So this is considerably deeper. Obviously, the NDX is tethered to the AI trade in NVIDIA and a handful of stocks, and those stocks went up with hardly a downtick into this top, and now some of that excess is being wrung out of the market. So that's not a big surprise either. You'll also note that the NDX closed a gap here. It's closed two gaps. It closed the same gap as did the SPX, but it's also closed yet another gap here. And then the next gap below here is 16,745, 16,825. But this, to me, looks like capitulation type of selling. Now, is it over? I don't know. We'll see. Now let's look at the Dow. Now this is where you can begin to make a bullish case, at least short term. The Dow closed not too far off its high. It certainly had a very positive day in light of the action in the NDX and SPX. It is only down from print high to print low, 5.7%. Now, I get it. I understand. I know it's 30 stocks, and the composition of the indices has a tremendous influence on how much they go up, how much they go down. But one thing that I will tell you, this is from 38 years of trading experience, when there is a significant move with institutional sponsorship, which all significant moves, intermediate term moves, have to have, all of the indices will move directionally in the same direction. Now, they may not move in the same direction proportionally, but they will move in the same direction. So when you have a situation like we've had over the last couple of days, and you see some relative strength in one of the major indices, such as the Dow, and it's not just the Dow, I'll show that in just a minute, then you're saying, okay, something has to give here pretty quickly. Okay, so that's the Dow. Let's take a look at the Russell. The Russell is off a little, about 9.6%. But it also closed pretty favorably on the day, relative, especially to the SPX and the NDX. Now, the last index I want to show is the New York Composite, which is all stocks listed, all listed stocks, and it too had a very positive day. It closed well above it in the midpoint of the day and above the closes of the previous 2 days. So all of these, just from a price structure perspective and looking at the typical correlations among the indices, there's some positive signs here. Now let's take a look at the technical situation, which is really interesting. This is NYSE data. The red line is a 10-day moving average of NYSE advancing issues. The green line is a 5-day moving average of advancing issues. And I've hidden breadth down here because I'm not going to talk about it right now. What is more important is what's happening in the panels above. Now, the 10-day moving average is right at the upper cusp of an extreme from where you almost always get very sharp rallies, even in bear trends. Now, this is data that's much more helpful at lows than it is in highs, regardless of bull or bear trend. And if you've been following me for a few weeks, you know we've had divergences that have been going on for months and months and months, and it meant nothing. Well, typically when you get on the, when you're selling in a decline, they mean something. So the 5-day moving average of breadth reached a level last week that we'd seen pretty rarely. The last time we saw this level, and just bear with me, I'm going to go back and show you some things. It was this was back in March of 2023. We had a similar reading in September of 2022, which was very close to the bear market low. Before that, this was June of 2022, very close to a low. I can go back years and years and show you the correlation. It's not causation, but it's correlation with price rallying when the 5-day moving average reaches into this level here. Now, could it be different this time? Could we have further washout? Absolutely. This is not a red light, green light, everybody load the boat. That I want to make it clear, that's not what I'm saying. You have to have your own trade plan. You have to have your own strategy, your own tactics. I'm just saying I am not pressing the short side here, and I am looking for a short-term low because of this information. What else can I show you that I think might be of value? That's pretty much it, guys. And another thing, and this comes from, again, 38 years of trading experience, all the noise around. This is also typical of lows being put in. We have the market freaking out over geopolitical events. We have the market freaking out because the Fed isn't going to cut rates 12 times this year. We have inflation, economic numbers coming in pointing to the continuation, if not acceleration, of inflation. So, all of these things are typical at lows. So there are a lot of things lining up here. Now, I do think that we're close, very, very close time-wise. I'm very, very confident in that. I'm not as confident, and you never can be as confident in price. But even if we get another flush to the downside, I just think the reward to risk here is increasingly to the long side of the market on a swing trade from a swing trade perspective. Okay, one last thing I want to leave you with. I do these reports every week. You can go to my website, alexandertrading.com. At the top bar, click on weekly update. It's free. You can go back and you can see all the updates that I've done for many, many months. And you can click on those updates and you will see, you can judge for yourself whether or not I'm consistent, I'm objective, and what I have is of value to you. I hope that you find that to be the case. You guys enjoy the rest of your weekend, and I will speak with you soon.